where procurement is losing negotiating power in 2026. Procurement leverage is not a fixed asset. It shifts with market conditions, supplier concentration, trade policy, and the options available to both sides of a negotiation. In several critical categories entering Q3 2026, those conditions have moved in ways that favor suppliers over buyers in specific markets. Understanding where the shift is sharpest matters more than hoping it reverses. Leverage in procurement is ultimately about alternatives. A buyer with credible alternatives to any given supplier holds negotiating power. A buyer with few alternatives, or with alternatives that take too long to activate, is in a weaker position than their contract terms may suggest. Procurement leverage is the ability to influence price, terms, delivery, or supplier behavior because credible alternatives exist. When switching costs rise or qualified alternatives shrink, negotiating leverage shifts even if contractual relationships remain unchanged. Over the first half of 2026, that shift has occurred across several categories simultaneously. Tariff volatility has raised the cost of switching. Supplier concentration has reduced the number of credible alternatives in capital-intensive categories. Critical mineral dependencies have deepened. Energy cost pressure has reduced the margin available to absorb unfavorable terms. Each of those shifts is identifiable. Together, they describe a procurement environment where the sources of leverage have changed and where teams that haven't recognized the change are negotiating from assumptions that no longer reflect their actual position. Tariff volatility has raised the cost of sourcing alternatives. The first source of reduced leverage is tariff instability, which has made the cost of switching suppliers harder to model and harder to justify to finance committees. When tariff rates are stable, procurement teams can calculate the landed cost of switching from one supplier to another with reasonable confidence. When tariff rates are unpredictable, that calculation becomes a range of scenarios, and ranges are harder to approve than estimates. Evalua's 2026 analysis of tariff impacts on procurement notes that companies may need to adjust sourcing strategies, shift production locations, or renegotiate contracts, leading to delays and higher operational expenses that disrupt established supplier relationships and require significant investment in compliance management. The procurement function that would benefit most from flexibility is the same function facing the highest switching costs in the current environment. Suppliers operating in constrained markets may have greater confidence during negotiations because buyers face higher switching costs, even when neither party states that explicitly. The US-UK Economic Prosperity Deal Framework, announced in May 2025 and still being formalized, and the ongoing Section 232 Critical Minerals Framework all reflect a tariff environment for 2026 that is actively being negotiated at the government level. That means procurement teams are operating in a policy environment that can change materially between contract signing and delivery. That uncertainty narrows the range of defensible sourcing decisions and tends to push procurement toward incumbent relationships, which is exactly where leverage is lowest. Critical mineral concentration has deepened dependencies that were already concerning. The second source of reduced leverage is concentration in critical mineral supply chains, which has worsened faster than most procurement teams anticipated at the start of the year. The United States is fully import dependent for 12 critical minerals and relies on imports for more than half of its consumption of an additional 29. China dominates global processing for several critical minerals, including rare earth elements, graphite, and significant portions of the lithium and cobalt value chains, despite producing a smaller share of the raw materials globally. That processing concentration is where procurement leverage actually lives, not at the mining stage, but at the refining and processing stage, where the number of qualified suppliers is smallest and the switching cost is highest. CSIS's June 2026 analysis noted that the U.S. has supply-side tools beginning to work and diplomatic frameworks expanding allied engagement, but does not yet have a coherent demand-side architecture that makes allied supply chains commercially viable over the long term. For procurement leaders sourcing materials that run through concentrated supply chains, that gap between policy intent and commercial reality is where the leverage problem lives today. Supplier concentration has reduced credible alternatives in key categories. The third shift is concentration among suppliers in categories where procurement teams once had more alternatives than they do now. Concentration, whether from regulation, qualification requirements, geography, technology, or market dynamics, reduces the number of credible bids, reduces competitive pressure on pricing and terms, and increases the cost of relationship failure because replacement options take longer to qualify and activate. This dynamic is most visible in categories where capital intensity is high and new entrants face long qualification timelines. Specialty chemicals, advanced materials, grid equipment, semiconductor adjacent components, and certain categories of industrial equipment. In concentrated categories, buyers have limited ability to walk away from incumbent suppliers, and that reality shows up in negotiated terms, whether or not it's acknowledged at the table. The procurement function's traditional response to consolidation is to build alternative supplier relationships before they are needed. That work, if it hasn't been done, can't be completed in a quarter. Qualifying a new supplier in a capital-intensive category typically takes 6 to 18 months under favorable conditions. Procurement teams entering Q3 without that work already underway are entering negotiations where their alternatives are thinner than they would like, and where incumbent suppliers have more pricing power than the contract language reflects. Where the leverage still lives and how to rebuild it. Reduced leverage in some categories is not the same as no leverage. The procurement function still controls the timing and structure of long-term contracts, the pace of alternative supplier qualification, the framing of the risk conversation with finance and leadership, and the depth of visibility into its own tariff and concentration exposure. Those are negotiating assets, and in a constrained market, they matter more than they did when the balance of power favored buyers across the board. That means prioritizing long-term contract structures in categories where spot market conditions are unfavorable, trading short-term cost optimization for supply certainty. It means accelerating alternative supplier qualification in the categories where concentration is highest, accepting that the payoff is 12 to 18 months out rather than this quarter. It means mapping tariff exposure in the current supplier base explicitly so that switching cost scenarios can be modeled before negotiations rather than discovered during them. The strongest procurement organizations entering Q3 are not assuming leverage will return when markets stabilize. They are rebuilding leverage now through supplier diversification, longer planning horizons, and better visibility into policy, energy, and material risks. In a constrained market, those capabilities become negotiating assets in their own right. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.